Keep in mind that this video is for entertainment purposes only. We strongly encourage you to read the full SEC and Department of Justice press releases, linked in the description below, for the full accounts of this video's topic. What's up guys, and welcome back to Wall Street Millennial. On this channel and podcast, we cover everything related to stocks and investing. Allianz is the world's largest insurance company and one of the most prestigious firms on Wall Street. Its asset management division, Global Investors, manages money for some of the largest pension funds and other institutional investors on the planet. Up until recently, it offered what it claimed were advanced investing strategies that used complex derivative securities to outperform the market. These funds were cleverly branded as Structured Alpha. But despite the prestige and vast resources of the firm, it turns out that Structured Alpha was all a farce to lure in unsuspecting investors. When the COVID meltdown of March 2020 hit, the Structured Alpha group of funds, which had managed over $10 billion of investor money, was decimated and forced to shut down. It turns out that the fraudsters running the fund, including lead portfolio manager Greg Tournant, had repeatedly lied to their investors over the course of years in multiple ways. They deliberately exposed the portfolio to excessive risk in order to maximize their own performance fees and bonuses, which added up to $50 million for Tournant in just 4 years. By manipulating the numbers and even fabricating daily performance results, they lured in investors who ended up investing in a ticking time bomb just waiting to implode. In this video, or podcast if you're listening on Spotify or Apple Podcasts, we're going to dive deep into the details of how these portfolio managers tricked investors into joining an epic option YOLO that ended up costing them billions. But before we dive in, make sure you've signed up for our daily business and finance email newsletter at wallstreetmillennial.com/newsletter. It's delivered straight to your email inbox at 5 AM every morning of the trading week, and does everything you need to know before taking on the day. All the day's news and market-moving events, expertly analyzed and distilled into a short 3-minute read, so you know all the things that matter most for your money. We're also adding a new featured stock to the newsletter once a week, where we highlight one stock that deserves your attention. In just a few minutes a day, you can prepare yourself with all the market due diligence that we perform for you. And the best part is, it's completely free. Go to wallstreetmillennial.com/newsletter to put your email on the mailing list and start receiving the newsletter today. The fraud's foundation was in Allianz's elite asset management group called Global Investors, and the desire of key portfolio managers to maximize the amount of fees that they received from investors. The Structured Alpha group of funds were several investment strategies that were marketed to potential investors. A key aspect of how the marketing materials described the funds was the ability for investors to choose between various combinations of beta and alpha targets. Alpha is a general term that describes the uncorrelated excess return of a portfolio, above and beyond whatever its benchmark is. For example, they offered one Structured Alpha fund that provided investors with exposure to the S&P 500, but also an extra 5% of annualized return. That extra 5% is the alpha component of the strategy, and the namesake of the Structured Alpha title of the fund. So how did Allianz hope to provide that additional 5% of alpha on top of the exposure to the S&P 500? The key was in using a type of security that isn't all that exotic, and that you yourself may very well have traded before: options. They used so-called option spreads to change the return profile under various market outcomes. There were 3 core types of option spreads that the funds used: range-bound spreads, directional spreads, and hedging bets. The range-bound spreads were essentially a bet that the market would continue its normal behavior, not going down too much and not going up too much. If the market doesn't move too much, then the strategy pays off. But if the market goes down more than usual, or even up more than usual, the strategy can incur large losses. Essentially, that means the strategy is betting against volatility. This part of the overall strategy provides the majority of the excess returns, or alpha, of the Structured Alpha funds. The second core option strategy was directional spreads. These spreads were designed to bet on less common market conditions, including benefiting from small sell-offs in the market of around 5 to 10%. Because these events are less common, the directional spreads only contributed about 1/3 of the fund's alpha. Both the range-bound spreads and the directional spreads are profitable during normal markets, but can incur massive losses during large crashes, or even large market gains. So they also use their third core strategy, hedging positions, which are basically out-of-the-money puts. Although they cost a lot of money to buy, if the market were to go down massively, these puts would theoretically pay out and offset the losses incurred by the range-bound spreads and the directional spreads. So you can see that Structured Alpha's overall investing strategy was to bet that the market would keep doing what it normally does. That means that in most years, the fund outperforms the market. With that outperformance comes lucrative fees for the fund's managers. It's been reported that the structured alpha funds had a very strange fee structure, in which the managers were almost solely compensated for performance. That creates an incentive for the managers to take on excessive risk, because in the likely scenario where the fund outperforms, they collect their fees. Over the course of 4 years leading up to the implosion, the lead portfolio manager took home a total of $50 million in bonuses from these performance fees. But in the less likely event that the strategy goes belly up, the investors are the ones holding the bag. Greg Turnant, the structured alpha lead portfolio manager, at some point grew unsatisfied with the level of outperformance of his funds during normal times. He wanted to find a way to increase the outperformance and thus his own fees. And what's the easiest way to increase the returns of a hedge strategy? Reducing the hedges. Although the hedge positions were a necessary cost of doing business when it comes to guarding against huge market crashes, in most years they just cost money without providing any return. So Turnant decided to drastically reduce the level of these hedges by making the put options farther and farther out of the money, without telling investors. Allianz's marketing materials promise investors put option hedges that had strike prices around 10 to 25% out of the money. In other words, if the market were to crash at least 10%, these puts should start paying out and providing downside protection. However, starting around 2016, these strike prices gradually got deeper and deeper out of the money. In 2018, the weighted average strike price of these puts crossed the 50% mark, and even the maximum strike price was more than 40% out of the money. That means that the market would have to crash more than 40% before these hedges started providing any protection. Historically, market crashes of that magnitude almost never happen. The last time it happened was in 2008, when the S&P 500 lost half its value over the course of a year and a half. During the dot-com bubble and crash of 2000, the S&P only went down about 40%, and it took over 2 years. Even if a portfolio held put options 40% out of the money, it's likely that they would have expired before the market crashed enough for them to pay out. So essentially, Structured Alpha's hedge positions did not hedge. Because put options that far out of the money are so worthless as a hedge, they're extremely cheap. As of the time of recording this video, you can hedge an S&P 500 position with 50% out of the money puts expiring more than a year from now, for less than 0.5% of the value of the S&P 500 position. But Turnant and others at Structured Alpha told investors that a strategy was still properly hedged. They maintained their position that the strike prices of the puts range between 10 and 25% out of the money, and that was only the beginning of the deception. They also manipulated their reports to investors about the daily performance of the fund, risk profiles, simulated market scenario results, and other things of that nature. One of the most shocking deceptions came in the form of blatantly manipulating numbers published in monthly reports to investors. In a stress test scenario to show how much money the fund would lose in a hypothetical market sell-off, Structured Alpha analysts calculated that the losses would come out to a 22.056% decline in the fund's value. But in the report, they changed that number to 12.056, exactly 10% less. In another published stress test scenario, the projected loss was divided by 2 before being sent to investors, from 24.6% to 12.3%. In a particularly egregious instance, they changed a 42.2% loss to a 4.2% loss, just by dropping one digit. And it doesn't even end there. In 2016, a prospective investor asked Allianz for daily performance data for the fund. In reality, because the fund had so many highly levered option positions, the daily performance was extremely volatile, frequently being up or down 5, 10, or even approaching 20% in a single day. Obviously, this is unattractive for large pension funds or other potential investors, because it shows that the fund's returns are extremely volatile. So Greg Turnant blatantly altered the daily return data of the fund to make the daily returns look significantly less volatile, by reducing the daily returns by about 1/2, and sometimes as much as 2/3. After seeing the false daily return data, the prospective investor made a huge multi-million-dollar investment in Structured Alpha. This smoothing of daily returns data was done many times over the course of several years, and multiple people at Allianz were in on it. Yet another shocking deception was in manipulating the reported returns of the strategies and in expected return reports to investors. Turnant sent false data to investors about the returns of their option strategies in order to conceal the fact that they had reduced the put option hedges. To manipulate the expected return reports, which is actually quite difficult to do, one of Turnant's colleagues even had to send him step-by-step instructions on how to alter the data and avoid detection by investors. Among other things, the manipulated data changed the theoretical maximum losses of the fund under a hypothetical scenario from $4.8 million to just $700,000. These deceptions led to investors understandably believing that their investments in Structured Alpha were giving high returns with low risk. Many investors increased their investments in Structured Alpha after seeing these false numbers, and the fund also was able to gain many new investors. In fact, there is so much interest in Structured Alpha funds that they secretly breached their maximum capacity, which in and of itself was another fraud to existing investors. In the COVID crash of 2020, the S&P 500 had a maximum peak-to-trough decline of about 35%. This hit the Structured Alpha funds hard, because the range-bound and directional spreads part of the strategy incurred massive losses, and the hedges didn't provide much, if any, downside protection. In the end, Structured Alpha lost about $7 billion and was forced to shut down. One of the Structured Alpha funds lost an astounding 97% of its value. A huge proportion of the funds was made up of pension funds for teachers, bus drivers, and engineers. The New York subway, the MTA, says that it lost over 95% of its investments in several Structured Alpha funds, investments that had previously been worth hundreds of millions of dollars. The MTA and other investors quickly started suing Allianz for their breach of contract by failing to hedge their positions. But Allianz immediately hit back at the accusations, at one point saying that the company would, quote, defend ourselves vigorously against these claims, unquote. Their refusal to admit fault culminated in the summer of 2020, when they released an official document on their website addressing the decimation of their Structured Alpha funds. The report basically said that the losses were not the result of anything that Allianz's portfolio managers did wrong. In the conclusion, it wrote, quote, while the losses suffered within the Structured Alpha portfolio are of course deeply disappointing, our analysis to date of the portfolio's March 2020 performance confirms that these losses were not the result of any failure in the portfolio's investment strategy or risk management processes, unquote. That report was published on the Allianz Global Investors website, but has since been removed. The SEC and DOJ also soon started investigating Allianz's Structured Alpha funds independently. According to the SEC, Tornant and other portfolio managers deliberately tried to conceal the misconduct from the investigation. Multiple defendants lied during testimonies, and at one point Tornant and a colleague met at a vacant construction site and discussed moving their own assets to offshore banks. However, in the end, the SEC was able to uncover the massive fraud, and in 2022, Allianz pleaded guilty to the charges. They agreed to pay $6 billion in disgorgement of ill-gotten management fees and penalties to compensate investors for their losses. They also agreed to pay $1 billion in penalties to settle claims by the SEC and DOJ, marking one of the largest penalties by the SEC since Enron and WorldCom. The guilty plea is an astonishing 180-degree reversal from Allianz's initial denial of wrongdoing. It is also one of an incredibly small number of instances in which a large financial company has settled charges while admitting guilt. Usually, large banks and other financial companies agree to settle without admitting wrongdoing. But it just goes to show that the evidence and data against the firm was so clear that it was virtually impossible for them not to admit it. Alright guys, that wraps it up for this video. What do you think about Allianz's massive, fraudulent failed options YOLO? Let us know in the comments section below. Also, don't forget to sign up for the daily Wall Street Millennial business and finance email newsletter at wallstreetmillennial.com/newsletter. In the meantime, thank you so much for watching and we'll see you in the next video. Wall Street Millennial, signing out.